Hi there, good afternoon, it's Louis here from Trusted Binary Reviews. Welcome to the very first of quite a few of the Trading Fundamentals series of videos. Lots of people have been asking me for various tips, and I thought let's just go from the beginning. And often a lot of the very basics are overlooked by people just diving straight into binary options and often just losing their money. One of the biggest reasons is because you're not fully equipped with the basic terminologies, and I do apologize to everyone who's already gone past this and are way ahead, but really a lot of people are missing the very basic fundamentals of binary options trading. So here we go, this is episode 1, and what are binary options, the basics. And if you can bear with me, I'll try and make it as not boring as possible. It's not boring, it's fun. Okay, so definition of binary. Some of you may know of a binary code, which is lots of zeros and ones, and it basically, binary just means that relating to, composed of, or involving two things. And in binary options, you've got two trading decisions you can make. You can make a call or you can make a put trade. Now, a call is that you are placing a trade, you are predicting that a price of an asset will rise, and a put is that you are predicting that the price of an asset will fall. So that's a put trade. Now, there are two possible outcomes also. One of them is in the money and one of them is out of the money, and they are commonly abbreviated across the board. You may have seen this a lot: ITM and OTM. In the money, out the money. In certain circumstances, they are the result is evens. I think that varies across the board, but evens is often where, well, the price is exactly the same as the expiry rate is exactly the same as the strike rate. We'll come over this in a little while, but so it's not strictly binary in terms of the outcome, because the outcome, you've got in the money, out the money, and evens, which is rare. But in that case, normally your money is just returned to you. You neither win nor lose. Okay, big reason people go for binary options. It's simple to get started with. You don't have to worry about things like leverage. It's everything's there in front of you. How much you're going to make. Obviously, you know how much you're going to lose if you're wrong. But it's very clearly stated the return and how long the trade is going to last. When does it expire, and you have a certain amount of control over that expiry time. So very easy to get started due to its simplicity, and subsequently very popular. And also you can make good money fast because of the high returns. The high percentage return in a very short space of time does also mean you can lose very fast as well. The payout percentages is favored for the broker. The broker is doing it to make money, so you need to have your edge to be able to make money. And we'll come to that edge in some later videos. But namely, strategies, signals are the two biggest edges that you can have. So you guys need to learn. If you don't know already, you need to learn the key terminology before you get started, because it's very tempting to just go bang and plow your money into a binary options broker and just click away because you can see the graph and it's very exciting. You can get caught up in the adrenaline, but it's a good idea, unless you're just loaded, unless you're completely loaded. Good idea to learn a little bit before you get stuck in, but also it is good to experience real trading, just keeping it small, small. So what can be traded in binary options? Now, if you've joined a binary options broker, you would have noticed there are various types of assets that can be traded, and they are broken up into 4 main groups. First one is currency pairs. So things like the euro dollar, the euro pound. I don't know, is there some people say euro dollar, some people say euro USD. I'm not sure if there's an official way. I've heard both quite a lot. But this is the this is a currency pair is a price which is defining the relative value of the base pair, which is the base currency, which is the first currency written. So like in the euro dollar, the euro is the base currency, and then it's how strong is how many dollars do you get for 1 euro. So it's the quotation of the relative value of the two currencies against each other. So in this example here, we have the euro dollar. The price is 1.1320, which means that for 1 euro you will get $1.1320. If the price goes up, now that can either be to the euro getting stronger, so you get more dollars back for 1 euro, or it could be because the dollar is weakening. So you've got two potential variables. There's millions of variables when it comes to economics, but you've got two sides which can affect the price. So either the euro strengthening or the dollar weakening. Now, conversely, if the price decreases, this is either down to the euro weakening or the USD gaining strength. Now, there's all sorts of news events that can cause this. When you look at an economic calendar, you'll see all of these things. You'll become familiar with these things. So there we go. So aside from currency pairs, you have commodities. Things like gold, oil, coffee, and sugar. Now, they are traded traditionally on commodities markets, but you can also trade against those in the land of binary options. Indices. Now, indices are, but you have the FTSE 100. Indices are basically a measurement of the performance of a section of a market. So the FTSE 100 is an average measurement of the prices of the top 100 companies in the London Stock Exchange. So, and then you've also got, for example, the FTSE Mid 250, which is the 101 to 350th companies in that same stock exchange. So they're just average measurements of a section of a stock exchange to give an indication of how well an economy is doing. There's other indexes like indices, not indexes. There are other indices like the Nasdaq and the IBEX in Spain. Okay, this one is quite interesting because you can also trade against the prices of stocks, very popular stocks, traditional stock prices. So things like Apple and Google and Santander. Now, I find this particularly good as a bit of a techie. I follow a lot of the big development conferences like Google I/O, and of course all the Apple events. Apple at least have one major event in September where they launched their iPhone. So these are very, very hot trading opportunities, and some good signal services will alert you to these. For example, Signals Binary, one of my favorites. They send out emails as well as the signals. They send out emails letting you know what is coming up with regards to things like, even today they sent out a message saying that Facebook is doing a dislike button. The things like that can really affect the price of a stock. So if you've got a bit of information that you're quite confident about, and you can actually just, as the news is released, you can watch what's happening in the market and you can ride that trend, and particularly if you've got relatively short-term expiries, you can really make quite a few trades if a price is increasing or decreasing throughout the day. So that's very exciting stuff. So always don't overlook stocks, because people often stick with currency pairs, but you can really do quite well out of stocks. So there we go. Next. Right, there are three things to consider once you've chosen your asset type. There are three things that you need to consider that are coming into play at the start of a binary options trade. Now, the strike rate or the price. This is also a very, very key factor. If you're getting a signal, if you've got a signal service that you're using, they will quote this. They will quote the strike rate or the strike price as the price that you need to have or better before placing a trade, because the signal that's being sent out may well be with a strike rate of say 1.100, and if it's a call signal, then you need to make sure that your strike rate that you're going for is less than 1.100. Okay, because otherwise the price is already moving in the direction of the signal. So you want to make sure you're getting a better, if not very, very close, and you can check this with the signal provider. They'll let you know, is there any leeway, or have you got to make sure that you're better than the strike rate. So that's a key thing to look at, is the strike rate. So basically the price at which you place, the point at which you place that trade. So if you're hanging on until to reach a certain point in a chart, and when you hit that strike rate, then bang, that's when you go. So that's the price at the start of the trade. Then you have the expiry time. This is either you get the very, very short expiry times, like 60 seconds, for example. You also have medium term, which will be next 10 minutes, next 15 minutes, half an hour, maybe an hour, a couple of hours, and then you've got even long term. Well, I suppose you probably call medium term up until the end of the day. There's a lot of end of day trading going on, again with signals binary, a lot of end of day signals being generated, and then there's also long term trading, which can be days, weeks, even months. So if you've got a general idea about a longer term movement in any given market, then that's the way to go, because then you remove daily fluctuations out of the equation. So next is payout percentage. The payout percentage. So this is the return on your investment. This is the return on. So if you invest $100, if the payout is 70%, you will be getting your $100 back plus the $70 if you are correct. Now there are some brokers that offer some kind of insurance. So if your trade loses, they will give you a certain amount back. So maybe 10% on the dollar. So if you place a trade of $100, you may well get back $10 if you are incorrect in your prediction. Okay, so here's my simple binary profitability calculator. It's actually reasonably complex to get this. For example, here, look at that formula to calculate the break-even percentage. So basically, the higher the return, the less often you need to be correct to make a profit. Okay, so let's just say that you're getting 100% return. So every time you're correct, you're getting 100% back. So you're doubling your money. Now that doesn't happen, because then the brokers wouldn't ever make any money ever. But here you can see that you would need to be right. Basically, you break even with getting 5 out of 10 trades correct. So there you go, you've got 0, and that's the exact percentage of the time you need to break even. So if you have a return rate of about 80%, then you see you need to be right 55.5% of the time. And even dropping down to 60%, you need to be right 62.5% of the time. So you need to be just over 6 out of 10 times right just to break even. So the higher percentage return, so if you can stick to higher percentage trades, that's more often than not with the high volume currency pairs, then you will make it far better, far easier to remain profitable over a longer period of time, because just sheerly because of the math involved. You don't need to be as correct as often when the returns are higher, and you will find that does come into play when you're doing this for a long time. If you but that doesn't mean to say just limit yourself to that, because if you've got an edge for whatever reason, you have an idea or you've got a formula or a strategy that does use an asset which the broker is offering, let's say 70 or sometimes even 65%, you can still make money as long as your strategy is good. So don't be put off, but bear in mind that is a significant factor is the return. 60% versus 80% is a very significant difference in the return. Now, I did mention the insurance. Now, this calculator, I'm going to make this available as a download on my website, because I think this will probably be useful to you guys, even if it's just illustrative purposes. Some brokers are offering an insurance, so if that is the case, you can input this figure here, and then you'll see what's the exact percentage of time you need to break even. There we go. Sorry, the exact percentage of trades you need to get right to break even. And then you go. So you can see here, if the broker is offering you 10% return, even if you lose your trade, there you go. You need to be 52.94% of the time correct if your return is 80% on a winning trade. Hopefully that's not just confused you all, but the calculator will be available to download, and I hope you find it useful. Okay, let's carry on. So the one factor at the end which determines if your trade is in the money or out of the money, or in fact evens, is the expiry rate or the expiry price. So if that expiry rate or expiry price, if you've made a call trade, the expiry rate is higher than the strike rate, you will be in the money. And conversely, if you made a put trade and the expiry rate is lower than the strike rate, then again you will also be in the money. So that's it. That's the deciding factor. And as I mentioned earlier on, a lot of brokers will just give you your original investment back if the expiry price is exactly the same as the strike price, which isn't very often. It does happen from time to time, but it's not very often. But you don't lose anything. Now we just have a quick summary just to tie things up. Now they're the very, very basic building blocks which I wanted to tell you. So now that you know those, you can go ahead and do some more research on them if you want, but they are kind of the very most important fundamental blocks to the beginnings of binary options trading. I haven't mentioned anything about strategies. I'm going to go into that in future videos. I mean, there's so much that we can cover, guys, but you got to start somewhere, and this is where I started. You can make some very good money with binary options, and you need to study up. There's not really this well, certainly from the Scam Aware series, we can see there are no one button push, you get rich overnight. Make thousands every day just from pressing a button and an auto trader doing it. You can make the money, but you need to learn and stick at it. It's very exciting, and you can do very well. There's risk involved, and I want to say, very, very importantly, don't start binary trading if you are trying to dig yourself out of a hole. That's not an answer. So just putting that out there, guys. If you're stuck for cash, don't start risky trading. It's not the answer. There's disclaimers on all the binary options broker sites, and they're there for a reason, because it's not just, you don't just put money in and then get more money out. There's a lot of skill involved, and determination. And if you are in a mindset where you can't afford to lose money, it affects your trading style, and you get very emotional about it, and you can't be like that if you're trading. So please, guys, if you're stuck for cash, don't start binary trading. Okay, that's a bit of wisdom there. It's just not, it doesn't help being in that mindset. Having said that, if you've got some spare cash and you want to learn, great. It can be very lucrative. I've done very well out of it, and I know lots of people who have done even better. Scary money. So that's good. Right, now you've got these very, very basics. If you want to get started, you can either pick a broker. there's a lot of reputable brokers out there. There's some bad ones as well. I'm nearly finished with my website redesign. I have my favorite brokers where I can recommend to you. If you do join up through any of the links on my website, that will support the channel. So if you feel like joining a broker through any of those links, great, go ahead. Or another option, which I tend to recommend to people who are starting out, is join up to a trusted signal service or a trusted software that requires you to join a broker to pay for that service, because the software provider or the signal service provider gets a commission by you joining up to that binary options broker. So you are effectively paying for that signal service just by joining up to that broker. So you're ending up with a broker and a signal service or software in the very beginning. So you're kind of killing two birds with one stone, because most people, once they've got a broker, they then start looking for a signal service. So if you just do that in the beginning, then you don't end up with more broker accounts than you initially want, and you're paying for a signal service. Again, all the links provided to my favorite software and signals. So as you know, I'm always testing brand new stuff and things that have been on the market, testing them out and seeing how much they work. So that's it, guys, and I'm keeping that very much up to date. And again, the links are always on my homepage. So that's all for me for now. As always, if you would like to leave a comment underneath, by all means, please keep it polite. This is a new thing for me, so hopefully I haven't bored you all. If you are already know all of these things, well, hopefully I've helped you out with a little bit of information. And for all you beginners out there, good luck. Let's have an interesting journey, and hopefully I can get you into profitability very, very fast. Okay, so now please subscribe to the channel if you haven't done so. It really does help to get the word out. It helps to get all my scam aware series videos out to help people not lose their money to all these dodgy scams. And share. If you would like to share this video on your social networks, it also does help. So that's it, guys. Hope you've enjoyed episode 1. I'd love to hear what you think. Lots of things coming up. This is going to be a big series of videos. Lots of things coming up. So I'll see you soon. Take care. Bye bye.